Ladies and gentlemen, hello and welcome, coming to you not quite live from One Take Studios. Today we're talking about mathematical models in purchasing a home. This is not an advanced level video on purchasing a home. This is just, hey, I've never purchased a home before and I'm kind of curious what sort of things go into this and how might some of the math work. Alright, so for starters, we're going to look at some of the things that you might want to consider working into this process. At some point in time, you're going to have to find a lender, alright, a bank, somebody else, probably a bank, maybe a credit union, and shop for the best rates and terms that you can get. Those do change from time to time, so it is worth looking into to see what you can get and from where. Also, at some point, you're going to need to find a home, and you're going to have to reach an agreement with the seller that they're willing to sell it to you at that price. Now, there is some mix here with people what should come first, what should come second. I think that it might help if you knew what you could afford before you go shopping for a home. But maybe you find a home first and then check out if you can afford it before reaching an agreement with the seller. That's kind of up to you, I suppose, but I would like to know what I can afford before I go shopping. And then when all those things are in place, then you're going to close on the mortgage or finalize the mortgage. And closing is something you've probably heard of before. I'm going to go close on my house today. So what that essentially means is you are finalizing the mortgage. You're going to sign your name and your initials like 5 million times, but there's also a financial transaction that goes with that. All right, so there's all kinds of closing costs that come to the table with that. You've got to pay for your attorney fees, taxes, lender administration fees. Appraisals might have been paid for beforehand, but you never know. So those might be, can easily be a couple $1,000s, and this is not talking about the down payment of your house at this point in time. This is just the process of closing and all the official paperwork that goes with it. So fun stuff. As far as a down payment, this is just a suggested number. Feel free to completely ignore me, but between 5 and 20% seems to be a pretty decent start for a down payment for a house. If you got more than 20%, great. If you can pay cash, you should pay cash because that'd be awesome. But this says if it's less than 20%, you pay PMI. What is PMI? This is private mortgage insurance. That means that if you cannot afford to put down at least 20% of the home, and you owe more than 80% of the value of the home, you must also pay insurance because the bank thinks that you might be a smidge bit risky and you might default on your loan, and they don't want that, so they want extra insurance against that. Which means if you don't have enough money to pay for this big of a down payment, you'll end up paying extra. Not exactly cool, but life, sadly. Okay. All right, so what else do we got here? I would like to preface the following by saying this right here. I've seen this. I'm going to throw this at you. I think it's ridiculous, but, it's kind of interesting because one of the books I'm working off of was written before the whole crash of economics and everything that happened, I don't know, a decade or so ago. I don't know, before I bought my house at any rate. But some people say that you can determine how much you can afford for monthly payment of your house by taking your gross monthly income and removing your bills from it. So monthly bills taken out of your gross monthly income, gross means before taxes, and then times 36%. Quite frankly, I think that that's going to be high. I think if you're going to spend that much on a monthly payment, you might be in trouble in other places. But have no fear. What else? Oh, we could do this. We could take the selling price, and so the house that we want to buy, as long as it's less than or equal to 4 times your annual salary, hey, you should be good to go. Okay, by that logic, oops, sorry, I hit the camera. By that logic, though, seriously, I should be living in a more than $200,000 home. And you know what? Nope, not happening. So these are both, to me, really good ideas for getting in over your head, which is bad. So in case you were completely unsure as to my opinion regarding these suggestions, I wouldn't go that direction. I think if you do that, you're going to get in trouble. All right, so what might be some better ideas then? Well, okay, we have this thing that's called an amortization table. An amortization table, which you can see mort for mortgage probably kind of in there. So this is specifically related to home buying, tells the monthly cost to finance $1,000 based on a fixed interest rate and the length of the loan. Notice a fixed interest rate, they do make adjustable rate mortgages, and they sell them to you kind of awesome, like, hey, it's adjustable. If the rate goes down, your payments will decrease. And they forget to mention, if the rate goes up, your payments will increase. No, not good. Fixed rate is usually what you want to be in, and quite frankly, even at fixed rate, you're not locked in. If you go with a fixed rate loan and the rates drop, you can refinance and you can get the better rate. It is possible. I've done it. So, what we might say instead is, all right, using this information, if I can get my hands on one of these tables, what I can do is this. I can take the amount of loan that I would like to have for my house and divide it by 1,000. So for every $1,000 that is in this loan amount, if I multiply it times the number that's on this amortization table, I'll get a really good feel for my monthly payment. And I can decide if that's something that I can actually afford or not, and it's going to be a little bit more reliable than this earlier stuff here. All right, so again, separating this from before, this is not a terrible idea. The nice thing about this formula is not only can I use this, but I can rearrange it and maybe see it from a different perspective that I might also find useful. So I've got this going on, or what if I do this? What if I say, hey, I know what monthly payment I'd like to make on a house. All right, this is a monthly payment that I feel comfortable paying. Well, now if I, again, rearrange this, if I divide by the number on my amortization table and times 1,000, I can figure out how much house I can afford. And so I would probably much be more likely to go into one of these things. Again, you have to get your hands on an amortization table, but it gives you a much better feel of what is actually happening and what you might actually be able to afford based on what you should be paying without getting yourself financially in trouble. All right, so let's run an example of that, shall we? I think we should do that. Let's run an example, and we are going to say, dun, 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 dun. All right, so we're going to keep this guy in hand, bottom part of this, not the top part. Top part's silly, we don't like it. All right, so we'd like to buy a $100,000 home at 5% interest for 30 years. I used to think a $100,000 home was a lot of money. You know what? It's not really, which is kind of sad. But we're going to pretend that we're just going to finance the whole $100,000. If you'd like to pretend, we could also pretend that it was a $120,000 home and that we're only going to take out a loan for $100,000. So pretend however you would like to pretend right here. We're going to go with 5% interest for 30 years. 5% interest is actually a little bit high for the market right now. But believe it or not, the amortization table that I'm working with, that's the lowest number available because of when the book was printed. Interesting, but true. And 30 years is the, I think, longest time frame for a loan. It's very common to have a 30-year loan, but again, if you can do less, you should do less because you'll pay less money in interest. It will save you money. And again, if you have cash, pay cash. All right, so what this would look like is I would have my $100,000 loan. All right, so that's going to be my loan amount. Divide by 1,000. Well, how many thousands are in 100,000? 100 times this 5.37. This is the number from my amortization table that says that if I would like to go with 5% interest for 30 years, this is how much it's going to cost me, $5.37 every month for every $1,000 that I'm borrowing. And that's going to give me roughly a $537 monthly payment. All right, so that's actually not terrible in my opinion. 537 would be the total. So I'm going to say, hey, if I'm going to buy a $100,000 house, maybe I think I can afford this. Great. Other things to think about though. Monthly payment might not just be this, especially if you run an escrow account through your bank, in which case they will take more than $537 every month. Why? Because they will then also pay your taxes for your property taxes when those come up, and they will pay your home insurance as well. Some people like that, some people don't. Just again, something to think about. All right, so what if you're saying, but I don't have an amortization table and I don't like not having these tables where I don't know where the numbers come from. I want something that's a little bit more concrete here. I'd like to see a real formula. You asked for it. Ladies and gentlemen, the fixed rate mortgage monthly payment formula. Are you ready for this? Now you think you're ready for this. Here we go. Ta-da! Isn't it pretty? Check it out. The payment, P is monthly payment, all right, careful, in some formulas capital P is principal, so know what your variables stand for, is going to be the amount that we borrow, and then all of this stuff, which some of it looks familiar. We've seen bits and pieces of this in other formulas. So we take the rate, which of course is going to be as a decimal number, divide by 12, so we're doing 1/12 of our annual rate. That makes sense. We're doing all of it plus interest. That kind of makes sense. T is the number of years. That is a cursive T. I'm sorry, that's the best I can do. So that's a T, that's a T, that's a T. Makes me want some crumpets. All right, so, and again, we're going to do that 12 months times the number of years to get the number of payments. All right, so Is this a pain in the butt? Yes. Is this a lot easier? Yes. But let's look at this, shall we? Let's pretend that we're going to use this exact same information, and let's compare how this formula works as opposed to an amortization table. So we are looking for our monthly payment. Our amount borrowed from up here is we are borrowing $100,000 on this home. Our annual rate was 5%. We're going to put that as 0.05. And the number of years, this is going to be a 30-year loan. So let's plug these guys in here and see what happens, shall we? What I'd like to show you is, ooh, am I going to be able to see it here? There I am. Yes, okay. Right there, right there. If you can see what I've done, I've kind of split the formula into two chunks already. So what I've typed in here is just the numerator. All right, so that's the rate divided by 12 times 1 plus the rate over 12 to the 12 times t, 12 times 30. This is the numerator of that giant fraction. It gets me one number. This is the denominator of the giant fraction. Is it possible to type in the entire formula at once? Yes, I personally don't like it. I think it's way, way too complicated. You hit one thing wrong, everything's wrong. This is going to be 1 plus, again, the rate over 12 to the 12 times 30th power and then minus 1. So this is my numerator, this is my denominator. What I like about calculators, graphing calculators, they keep memories of these things. And so it's easier now for me to put everything together. So what I want to do to find my monthly payment is I'm going to take my $100,000, oops, come on, please let me, there we go, $100,000, all right, so that's my A, times, all right, so we are multiplying, and then what am I multiplying by? Well, I'm multiplying by these two guys, so I'm going to go here, and if I go up, I can grab my numerator and hit enter, divided by, right there, and then I can go up again, and I can, whoops, there we go, and I can grab my denominator, and I can put it in place without having to retype all that stuff. My division sign is still there. It's going to be very accurate. It's going to have all my numbers here. So, if you remember, I don't know if you do or not, but if you remember, based on the amortization table, we said this is going to be $537 a month. Here is what the fixed rate mortgage monthly payment formula does. $536.82, which is extraordinarily close to what we saw on the formula but with the amortization table. All right, so you've got a couple of options there. This is a few ideas of how it might work, and yeah, happy shopping.